Hello everyone and welcome to the Compak Market Wrap weekly YouTube update for July 24th, 2020. I'm Moe Ansari, President of Compak Asset Management, and a lot of you have been tuning in for the last 30 years to my daily radio broadcast that is syndicated nationally. So welcome back all of you, and this is the weekly update that I'm going to do every week, recapping the week's activity in the markets and the technical and the financial movements in the markets. As you know, I've done this for about 42 years now, talked about the financial markets, and for 30 years I've done the radio broadcast. But thank you all of you that have tuned in over the years, and all of the new listeners, welcome. Hopefully you'll find the material interesting and will give you some food for thought. You can also get the daily market update on Apple. On the iTunes store, if you just go there and type in Market Wrap with Moe Ansari, you can download the free app and you will get a 1-hour daily broadcast that I do in much more detail on a daily basis. On the weekly basis, I'm going to do this where you can see the charts on the YouTube channel and get the weekly update. And don't forget to like the channel so you do automatically get the updates on a weekly basis. I'm going to talk about government and politics. We have to take a look at that a little bit from an economic point of view. I'm going to look at the events that drove the market this week, central banks, what they did or did not do, the global economy, and then we'll take a look at the fundamentals and technicals. And this is going to be our focus every week to bring you up to date on all of this. So I'm going to start today with the pandemic update, government and central bank actions, the U.S. economy and markets, technical analysis of the markets, and show you the charts. Really, that is the language of the markets. It'll show you exactly where we are. How did we look at the market at the beginning of January? Why did I give you a target of 32.85 to 33.15? And if we do get above 33.15 for the S&P 500, where do we head next? Let's start with the coronavirus pandemic. This is where we were 2 months ago. A number of these states, so when you look at all of these states, they were all in green. And that meant the pandemic was going down. Those few states that were above. Here we are today where we're seeing just about every state the pandemic is growing rather than coming down. There's only a handful of states where it is coming down right now. So the pandemic is, I think everybody has made the decision as a society we have that we are going to live with it. We have to live with it. And there will be a certain number of casualties, probably somewhere around 170,000 to 200,000 people by the end of this year will die from the virus. Also, 3 months ago, if you came to the daily broadcast, I talked about, I thought if we reopen, we are going to get the young people going out, the 20 and 30-year-olds. They will go out, they'll get the virus, but it won't be as serious. Unfortunately, they are going to pass it to the uncles, the aunts, the parents, the grandparents, and they are going to get sick, and probably the fatality rate will go up. That's where we are now, 3 months later. I think everybody is realizing that we might have to shut down again because of the spike of the virus that we're seeing. But we're also seeing some positive things that are coming out. People are starting to wear masks. That's the only defense we have at this time. Masks, social distancing, and washing and good hygiene, washing your hands regularly. If you see the China, they were doing wearing masks since February. 80% of them were wearing masks, or as far as the population is concerned. You look at Italy, they started doing it somewhere, they were in the 20% range, and then they took off and got to 80% in March very quickly. Same thing happened to Spain. There were very few people who wore the mask there, and then we saw them take off, and they did get there by the end of April. France did the same thing. United States, we did start at a zero level, but we've sort of stayed here in the 60% range where people said they're willing to wear a mask when they go out in public, but there were about 40% of the people, but now we are getting to about the 80% range. And that's a good sign because that's the only thing at this point that we can do. Hopefully we are going to have a vaccine by the end of this year and we can start taking the vaccine, but it's still unknown how long it lasts, the immunity from the virus, how long it's going to help. So those are the things that we have to think about. Now we have to look at where we started in this pandemic in February. Markets were looking great at the beginning of this year, Everything was wonderful, and then the pandemic hit. It caused a bear market, but it was an event-driven bear market, as we call it. It's not a structural bear market. There was not financial excess in the market like we saw with the banks loaning out too much money they did in 2008 or 9, or we saw the dot-coms at 500-600 PE like we did in 2000. Well, now, 20 years later, we do have an event-driven bear market, but that can't, as soon as the event goes away, the market goes away. The market is anticipating that we are going to get to the other side of this by the end of this year. They expected the market that the second quarter would be terrible. Third quarter, we're going to come back very quickly and everything will be wonderful. I think now we came back up, but we have stalled, and now we have to wait here. And I think the market has also been in a sideways pattern because the virus has gone in a sideways pattern or increased. When the virus numbers start to come down again, I think the market will start looking at the upside. Another thing that has helped the market is government intervention. I'll talk about that in a minute. Let's talk a little bit about the vaccines. We've got 140 vaccines out there right now, 165 that are being tested out there, and there are 4 that are in phase 3. That is the big thing. When you get to phase 3, that's on thousands upon thousands of people, human beings are taking this vaccine, and hopefully the Oxford vaccine, the Moderna vaccine, those are 2 that everybody is talking about. If we can get those to mass production, hopefully by the end of this year, and find out that it does give us immunity for a long period of time, at least for a year, then I think that would be a very positive sign. And that's what the market is hoping for. If we don't get there, that could be a problem. Most governments, the United States just signed a $1.95 billion deal with Pfizer that is partnering with BioNTech, that they are going to have 100 million doses ready, and then we could have 500 million doses next year on the virus. But the virus has got to show that it works and the side effects are not. Let's talk about the government action. That's money being put in by the government, and that is the biggest thing that is different this time around. The government has come in and supported the markets where we had this outside event. We needed money coming in, and that's what we did. We got money to cover this valley that we have, to get us to the other side, to where we have the vaccine and we can open up. And that is what the government has done on a much more faster, much more efficient scale this time. You can see that in 2018, Mr. Powell said that we've got a long way from getting to normal. That means that the interest rates will continue to go up, and the market came down about 20% in the last quarter of 2018. And then he said it's just below normal right here. Then he said tightening is on autopilot, and that made the market come down dramatically. But then he walked back and said, wait a minute, we're not, the expectation was in 2019 the Fed was going to raise interest rates 0.25% every quarter. Then he walked that back at the beginning of 2019. The market went straight up. We had the market started coming down in April of 2019 because of problems with the trade deal, but the Fed said it will come in and act appropriately. The market went up. He talked about a mid-cycle adjustment. The market came down again. Then in October of last year, we started doing what is called the mini QE, where the Fed started buying treasury bills. The market took off to the upside. Then in February, the pandemic hit. The market gapped down here, and that's they had the emergency rate cuts that helped the market for a couple of days, continued to go down. Fed decided at the end of in the March that they are going to do QE. They started QE, and that is when the market took off to the upside, and then it started to buy in the middle right here as the market went up. The Fed decided to buy fallen angels, where they decided to buy bonds from companies that were not doing as well. That has helped the market go up, and that has caused the market to come back sharply higher. This is the S&P chart. Each red and green bar is 1 day of trading. You can see that it has come up, but for the last 2 months, we've sort of gone sideways here, where we've gone up, come back down, and we've come back up again. We will see if we can break out to the upside, and I'll talk about the catalyst that we need to have to get this market going again. We've seen more global stimulus this time around in a very quick speed, in a very fast pace. And what we're seeing here is interest rate cuts and Fed and the central banks helping out. That's what we've seen with all of these. In the gray bar is government spending. As you can see, the United States, we are giving, the Fed has done some, but the government has come in and put $2.2 trillion, the CARES Act as we all know it, and they're talking about more money now. Every time the government talks about, or we get close to, or we hear about a stimulus plan, the stock market goes up. A lot of this money does show up in the stock market or the real estate market. It helps people get from where they are now to where they want to go. You saw this was in 200 days. This is what we saw in 2008 and 9, the government coming in, putting money, and it took them about 700 days to put in $787 billion, about $800 billion. We've already done $2.2 trillion in a matter of 90 days. It's been an unbelievable pace. And it's just not here in the United States, but we're seeing the same thing. At the beginning of this week, we heard about that the Europeans had finally got together and they were going to issue Euro bonds, where the bonds are going to be secured by all of the European nations, even though the money, 390 billion of it, is going to be given as grants to some of the countries like Portugal and Spain, or Southern Europe as it's called, by the Northern European. So we are getting closer and closer to the United States of Europe. So they are coming together, like we issue bonds here from the United States. Treasury issues them, but they're backed by all 50 states. We do have bonds issued by every state also, the municipal bonds, and then we have state bonds, but we have the national bonds, and that's now where Europe is getting to, and that could be very good for the Europeans. We're also looking at round two. The Republicans just today finalized their $1 trillion proposal that they're going to put out, about $1 trillion a proposal. The Democrats already in May passed the HEROES Act with $3.4 trillion. Now they're going to negotiate and try to get this. But a lot of these, unfortunately, these provisions that we had in the CARES Act expire. The provisions for $600 a week in unemployment, extra unemployment benefits, the evictions that were halted because of the CARES Act, they all expire at the end of this month. Are we going to get some kind of deal to expand this for a period of time? The Republicans want 70% of what people are making previously as unemployment and extend that. They might do that before they go on recess at the end of this month, which is only a week away. So we need to get that done. If they do, I think that's going to give the market the next catalyst to break out. If they do not, then we might have to wait until they come back, and the market could go sideways or lower from here until we get to that point where we get more money coming into the system. Looking at the markets, we go through this every year where the markets go up and down. These red dots are where the market shows you over the last 40 years how much the market went down during the year. The gray bar shows you where the market closed at the end of the year. Look at 75% of the time, the market has closed higher. 30 out of 40 years, the market has closed higher. What that means is if you get out of the market and go to cash and stay out there for a year, the probability is that you're going to be wrong 75% of the time. So you want to be in the market, but you want to try and avoid the major bear markets like we saw in 2000, like we saw in 2008. We were down 34% this year. The trick is to be able to handle the volatility, and we have snapped back up this year. Anybody who sold out at the end in March is 25 to 30% behind in the market now. It'll be very difficult for them to catch up ever with the market. Looking at the PE levels, we are pretty high right now, but we're looking at historically, the PE is about 16.38. Right now we're at about 21.72. But what we are seeing, the E is something that's the earnings. You take the price divided by earnings, and that's called the PE level. Earnings are not sure. Right now, no one knows exactly what the earnings are going to look like because companies are not sure what their sales are going to look like in the third and fourth quarter of this year. So we have a lot of uncertainty, and that's why the market has come back up, but we don't know exactly what the PE is. But if you take the Fed model, as it's called, you take the interest rates and figure it out where the market should be, it shows that the valuation, looking at interest rates as zero as they are, the PEs could be higher because of people used to buy bonds instead of stocks, 5-year, 4 or 5, when they get 4, 5, 6%. They say, okay, but now when you get 1% or 0.5% on bonds or nothing, so you're saying, what alternatives do I have? That's why the Fed model is showing that the value of the stock market is around 3,700, which is another 15% higher than where we are right now. So that would be the value because of interest rates being so low. We did have a bear market. You see these event-driven bear markets, they go down. They do not go down as much, and that's really the good part of this that we've seen, that they're down, but they don't last as long either. You can see the average length. If it's a structural bear market, it lasts a lot longer, but the event-driven bear markets do not. And same thing, the average time to recover. Look at the event-driven bear markets, comes back very, very quickly. And that's what we saw. We saw an event-driven bear market. People say, okay, the Fed is putting in trillions of dollars, and the whole world is putting in money. Every central bank is doing the same thing. And that is going to help us get from here until we get to the virus. Now, the virus was expected to subside by now. In the summer, the heat would kill it, but it has not. So that has caused some anxiety, and I believe in the next August and September, seasonal months that are not good for the market, so we could see volatility. Plus, we've got the election anxiety coming up, and that is going to cause some volatility in the market. Will your portfolio be able to handle the volatility? If you go down 10 or 15%, how much are you willing to go down? And that's the right mix of assets that you should have in your portfolio, and that'll show you exactly how much volatility. And you see, again, you should have some kind of idea that if the market goes down 20%, within a 95% probability, how much will your portfolio go down? And that is what is called a risk number. Looking at the subsequent bear markets and the returns, the average after a bear market 1-year return is 57%. That's what we see the following year. Well, we are already up about 30% off the lows, but we think we have more to go on the upside. The trick is to have the right balance in your portfolio. If you have a 50-50 bond and stock portfolio, and held it for 5 years, over the last 70 years, it has never been a 5-year period. The worst you could have done is make 1%, the best you would have done, but there's never been a 5-year period where you would have lost money. So even if you bought the very peak of the market, obviously, and did nothing, but you have to have somebody who can proactively change, not the people who take you all out of the market and get all back into the market. I call that playing poker with your financial future. Don't try to do that, and don't try to, the other people are the hold and hopers. You heard that term that I coined in 2000, where I said, look, those are people holding and hoping they're going to come back. Unfortunately, those dot-coms are dot-gons, and they are dot-gons today. You need to find the right balance between proactive management, being able to handle the volatility, and having the right mix of assets. That is individual to each one of you. Trying to buy this one stock, trying to buy this one particular mutual fund, trying to hit the home run with it, it's a fool's errand. You're trying to buy the lottery ticket. Having the right mix of assets, having the right plan, looking at it over a period of time, making the adjustments, mid-course adjustments, proactively looking at all of that, combining it gets you from where you are now to where you want to go financially. That's what creates wealth. Trying to chase this stock or that stock is a fool's errand. Let's talk a little bit about the election. This is my election map. It's only got 5 states on it. It shows the entire United States, but it only has 5. Whoever wins these 5 states, Mr. Joe Biden or Donald Trump, whoever wins this will be the next president of the United States. I know there's a lot of polls out there right now showing that Mr. Biden is ahead. 3 months is an eternity. And that's where we are right now. We are 3 months away from election. Anything can happen in 3 months. So I would not put a lot of credence in the numbers that we're seeing today. We also saw Hillary Clinton was going to win. Everybody saw all the numbers there. So I think people who are celebrating now are a little premature. People that are depressed right now, don't be as depressed. That's what I would say. We're still 3 months away. But anybody who wins these 5 states. But if you look at the numbers today, it's showing Mr. Joe Biden has an 89% probability of winning, and Mr. Donald Trump has about 11%. This is according to the betting, people who are willing to bet real money on the outcome. Also, we're seeing that 56% of the country disapproves of the handling by the president of the economy, and the net rating is minus 15 right now. Anybody who has a minus 10 rating has never been reelected. There was only two of them. That was Jimmy Carter in 1980, and we saw George W. Bush in 1992. They both had negative ratings of about 10%. That means that their approval rating and the disapproval rating, the difference was more, minus 10% or more. Right now, the president is at 15, but as I mentioned, that we're still 3 months away from the election. Also, we're showing that the election year, if you look at the incumbent party wins, if the market goes up August through the end of October, that's a 3-month period that has a very high probability of showing you exactly who will win the election. So August, September, and October, if those 3 months the stock market or the S&P is higher, the incumbent wins. If there's only been twice that has happened, that the market was down, the incumbent lost. So we still have the market indicator will tell us a pretty good idea how we stand somewhere in September or October. But I think also by that time we should have a pretty good idea who is leading. Now you have to be prepared to what happens if Mr. Joe Biden is the next president of the United States and we do get a Democratic Senate also, or what is known as the Democratic sweep. What happens? Probably there's about $4 trillion in taxes, and there's a number of programs that he has proposed. I don't think that he will be able to put in the entire $4 trillion in taxes. I don't think that happens. I think we're looking at somewhere up, and it also depends if the composition of the Senate. If the Senate is Republican, then I think not much changes. I mean, yes, the narrative might change, but overall trying to get legislation through will be difficult. If we get a Senate majority of Democrats in the House, which is expected, and in the Senate, and a Democratic White House, then we could see the narrative change. How much will it change? Will Mr. Biden move extreme to the left? We will have to wait and see. If he does, then we have to reevaluate and have a portfolio that is ready for those particular circumstances. Not looking backwards, you have to be looking forwards now and be prepared that if A happens, you're going to do B, and if B happens, you're going to do C, and have those. But if it's not the end of the world. When we have a divided government, 11% has been the return. When we have a unified government, that means one party is running the entire Congress and the White House, the returns are 8%. So if we have a Republican Senate, the markets have been, they do better with divided. We are seeing the tensions heat up with China right now. Today, China announced that they're going to close our consulate in Chengdu, China. We closed the Houston consulate, the Chinese consulate in Houston. This is something that I believe will continue to ratchet up going into the election. The Chinese have to become better players in the world market. They have to understand that just can't steal stuff from the rest of the world. They have to be responsible partners in trade and the rest of the world. Are they going to make those adjustments? I believe they will. We will find, because the world is integrated and China still needs the rest of the world, and the rest of the world needs China. So it's a mutual, something that mutually that is desirable. Now, how much are the Chinese willing to give up as far as become fair traders rather than it depends on the pressure that is being put in. But I think at this point, it doesn't matter if it's a Democratic or a Republican president. I think the world has woken up to China, and it's going to be how far the administrations are willing to go. Are we going into a Cold War or just a trade war? Well, we're sounding more like a Cold War, and I think the rhetoric and all of that will heat up going into the election. But after the election, I think everybody will calm down a little bit and we'll get back to negotiating. But I don't think we go back to business as usual with the Chinese. That has changed forever. It is not going back there. And the business, I think businesses are moving out of China. They're coming to Mexico. They're going to other countries. And they're coming back here to the United States also. Let's take a look at the technical picture of the market. This is where we are right now. We can see that our target that I had put out was between 32.85. That's what I was looking for right here, to about 33.15. 32.85 to 33.15. That's my target here that I put out. We hit 32.80 yesterday. That's close enough to 33.85. And I projected this. This is the beginning of each one of these charts is 1 day of trading. This projection came from this third wave high. Everything moves in 5 waves. This is wave 1 on the upside, wave 2 to the downside, 3 to the upside, 4 to the down, and this is the 5th wave. Once we get to wave 5, like we did here in February, we start an ABC correction, or maybe 5 waves to the downside. Now, if we do get above 33.15, we break out above here, the resistance comes in right here. There's a gap on the charts. That's where the markets start to go down, and the gap gets filled at 33.28. If we get above 33.28, probably headed to new all-time highs. That's probably take out this high, and we'll get to new highs. On the weekly chart, we've completed an ABC. We're starting a new wave count to the upside. This is wave 1, wave 2, we're wave 3, and we could see a 4th wave correction. That's over a number of weeks. That's what we could see over the next 2 or 3 or 4 weeks to the downside, a pullback in the markets, but that'll set up some good buying opportunities. The people who've missed this entire rally might get a chance to put some money back. I don't think we go back to the March lows, but we could come back to about 3,100 to 3,040. Those are the numbers I'm looking at as support. The NASDAQ also has wave 1, wave 2, wave 3, and we're starting wave 4 to the downside, and after that we think the wave 5 is still to come. So S&P is not looking as good. Looks like it's completed wave 5. The NASDAQ is not. The NASDAQ on this correction could come back down and then start going back up again and pull the rest of the S&P higher. As we know, 25% of the S&P is only 5 NASDAQ stocks, the tech stocks. And the tech stocks this week were down the most, and they pulled down the NASDAQ more than the S&P for the week. So I think from there we should turn around and head back up. Weekly NASDAQ chart also shows that we're completing wave 3. We could see a 4th wave correction, then off we go on the long side. Here's the oil chart. That looks like it looks pretty good. And here's the gold chart, where we had been in a long sideways pattern. We broke out last June, and since then we've come and made new all-time highs today. We could see a pullback down to about 1750 to 1720. If we do, I think that's going to be a buying opportunity in the gold market. I think gold is supported by everybody printing money. Everybody's looking for inflation. That's what they did in 2008 and 9. We didn't, because I'm looking at the velocity of money. You can have a lot of money, but unless it's going out and circulating, somebody has $1 billion, but it's sitting in their garage, it doesn't make any difference. If they go out and spend it, then they're buying products that somebody has got to make and so on, and it circulates in the economy. The velocity of money is what you have to watch, and that's why I don't see the velocity is not going up, and that's why I don't worry about inflation in the short term. But why gold is going up, it is what is people buying as a safe currency. That's what they're looking at. They used to buy bonds, but bonds give no interest now, so they're buying gold because they're saying, look, if we're buying a zero return that doesn't give us interest, maybe we can make more money in gold, and gold has done very well. So what are we looking at for this week? I think corporate earnings are going to be the big driver next week again. We get earnings from some of the large tech companies. I think what could be a problem, if we don't get those earnings, and earnings have come in better, they come in worse. The bar is set so low. If the earnings come in better than they did, than the expectation, I think that's going to help the market, and I think it will. But if COVID fatalities continue to rise and the infections continue to rise, we go into a lockdown phase in more states, which I think people are starting to realize that they have to wear masks and social distance. I think we are going to do better with that, and the fatality and the infection rates are going to come down like they have in Europe, like they have in some of the Asian countries. I think one thing that could cause the market a lot more is a flare-up, a trade or military flare-up between the U.S. and China. That is something that is a probability, but not a very high probability. And obviously what could long-term, that if we see the polls continuing to show for Democratic sweep, that means the House, the Senate, and the White House, we'll have to wait and see. We're still far away from that. On the positive side, if we can get corporate earnings, they come in better. We get a vaccine, which we have a couple of them, 3 or 4 of them right now, going to phase 3 trials. We hear progress. That's going to be good. We get, in the short term, if we get a deal between the Republicans and the Democrats to get another fiscal plan out there, or more money being sent out, that is going to be, if you look at the 2008 and 9, we saw a number of very large moves in the market. Every time the government announced a program, we saw the market pop back up. So if we can get a positive agreement between the Democrats and the Republicans in the next week or so, before they go on vacation in August for their summer break, that could be, or at least an extension of the unemployment benefits for that period. Also, we've seen that, as I mentioned earlier, the Euro bonds that have been coming out this week, that could be very good for the debt being carried by all of the nations in Europe. That's going to be positive, and that, I think, you have to look at some Europeans. That is a wrap-up of the markets for this week of July 24th. I will be back with you next week, and again, make sure you become a subscriber. Click on the subscribe button so you can get this weekly update. You'll be notified when I post this weekly update for you every week, and you get the weekly update. Also, download the app from the Apple Store for Market Wrap with Mo to get the daily 1-hour radio broadcast that I've done for the last 30 years. Again, thank you for watching. I appreciate it, and have a wonderful evening.